In this presentation, we will take a look at multiple choice questions related to financial statement analysis, going through those questions and then practicing test-taking skills with them. First question, internal users of financial information, A, are not directly involved in operating a company, B, are directly involved in operating a company, C, include shareholders and lenders, D, include the IRS, and E, include vendors. Let's go through this again using the process of elimination. Internal users of financial information, either A, are not directly involved in operating a company, and if we're comparing and contrasting internal versus external, we would think the internal, possibly management, would be involved in operating the company. So it doesn't seem like A would be the one. B says are directly involved in operating the company. A and B then contrasting each other fairly closely, often an indication that might be one of the answers. And so I'm going to keep B, that seems more likely. C says include shareholders and lenders. Now, shareholders and lenders, you would think are, external. They're not involved internally in the company usually. And then we have include the IRS, and they're kind of like our silent partner, I guess. Involuntary silent partner, but not directly involved in the company, I don't think so. And then E says include vendors. And you say, vendors, we're involved with vendors on a day-to-day business. That's who we typically purchase from. So I'll keep that for now. We'll keep A and E, go through it one more time. Internal users of financial information, either B, are directly involved in operating a company, or E, include vendors. And the fact that A and B contrast each other fairly closely would make me think that it's one of those two, and B just sounds like the best answer. Any are directly involved in operating the company. That's including management. So usually when we think of internal users, we're thinking management. We're going to keep it final answer B, internal users of financial information. B, are directly involved in operating a company. Next question. Meeting short-term obligations efficiently generating revenue is A, liquidity and efficiency, B, solvency, C, profitability, D, market prospects, and E, avoiding bankruptcy. Let's go through this again using the process of elimination. Meeting short-term obligations and efficiently generating revenue. Now note what we have here. We have categories in essence of ratios. Remember, when we think of our ratios, we broke them out into these categories. These are in essence the categories. Question then being, which category of ratios will be the ones that are going to help us for meeting short-term obligations? Is it the liquidity and efficiency ratios, the solvency ratios, the profitability ratios, or the market prospects? And then we have avoiding bankruptcy, which is not one of our ratios. So that's probably the fact that there's only 4 means that that's probably not the one. So it's going to be one of A through D. And for this, we basically kind of have to know what these items mean. So meeting short-term obligations, that's going to be liquidity and efficiency ratios. So the liquidity and efficiency of our 4 ratios is the one that's going to be meeting those short-term obligations. And remember, the types of ratios in there include the current ratio, the asset test ratio. We're always comparing the current assets to the current liabilities because we're trying to see if we can meet those short-term obligations with our current assets. So we're going to keep it at A, final answer, meeting short-term obligations and efficiently generating revenue, A, liquidity and efficiency.